Saurabh, what are you telling your clients to do on the banking space specifically now after the big correction that we've seen?
I think this has been our main underweight over the last year. So the view I've articulated to clients over the last year is that start buying cyclicals, but stay into high quality cyclicals. But the main cyclical sector we've been very vocal about avoiding is banks, and within that private sector banks. Our concern has not just been credit quality. That's the obvious concern in banks, but our concern is also about intrusive regulation, which I think will gradually crimp the profitability of the private sector banks, particularly with regards to third-party products. So bank assurance products, I think the profitability for the banks to sell these insurance products will diminish over the next couple of years. I also have question marks about certain income recognition practices that the private sector banks follow. So we've been very vocal there that the top private sector banks are overvalued and should be avoided, and that remains the view even after the correction. I think the correction in private sector banks has still some way to go.
What kind of price to book multiples do you see some of the leading private sector banks coming down to? Because they had held a range of between 2 and 4 price to book over the last many years.
I think there's two sorts of adjustments you'll see with the private sector banks. They've been clocking ROAs of around 1.6%. I think over the next 2 to 3 years that will come down to around 1.1, 1.2. And if you lever that by around 10 times, 11 times gearing, you get to an ROE of around 14-15%, which is what I think a good bank, most places in the world should do around 14-15% ROE, rather than the near 20% ROEs that our private sector banks post. So once the ROE pulls back from 20 to around 15, I think the price to book will stabilize for a decent bank, for a good private sector bank. The price to book will stabilize at around 2 times. Now clearly several of them are trading at many multiples of 2 times, and hence the pullback I think has some way to go.
The other big question or debate must be on consumers after their recent valuation expansion. They have given up some of that froth over the last 10 days, but could there be further adjustment?
My read of the consumer pullback is this will continue. I think what's happened, as you were pointing out earlier in the program, is over the last couple of years, a lot of investors, both domestic and foreign, have parked themselves in pharma and consumer stocks in the hope that this will be a safe haven. Now, yes, they are a safe haven, but the valuations have got so unreasonable, 30 times, 40 times for what are fairly, humdrum consumer plays. Valuations have got so unreasonable. I think you're bound to see a pullback. And paradoxically, as signs emerge of a recovery in the country in the second 6 months of the year, I think the pullback will get sharper still. So our emphatic recommendation to clients has been start moving towards auto, towards the better auto plays, towards the better industrial plays, and say 3 or 4 financial plays where there are literally small lenders and insulated from the worst ravages of power infrastructure and real estate. So I think there's this whole notion that you can park yourself in consumer stocks and pharma stocks for years at an end. I think that will gradually unravel as the year proceeds, and particularly as it becomes apparent that the economy will come out of the funk that it finds itself in.
Would it hold true for a stock like ITC?
With ITC, we have a sell on pretty much the entire FMCG space on valuation grounds. Yes, some of them have greater defensive characteristics than others, and clearly ITC is one of them. A cigarette monopoly is as close to a Fort Knox as you can get in this sort of economic climate. But again, the question is, has the stock been re-rated far too much in this sort of climate? And my answer there would be yes. I think you'll see the entire FMCG class pull back from say around 25-30 times to a number which is more around 15-20 times. A healthy company growing profits around 20-25% a year should be trading at 15 to 20 times, even if you are an FMCG company with the ability to do buybacks and dividend payouts. So if you were to look at the Indian market, I think you'll see 2 sorts of rebalancing over the next year. First is this sort of very high weightage that banks have. I think something like Nifty still has 24-25% in banks. That is bound to come off. It's unusual for an economy with 6-7% growth to have this higher weightage in banking, and particularly in 6 private sector banks. You'll also see the whole concentration of market cap in FMCG and pharma also come off a touch. IT I think will gain market cap weight as the dollar and the American recovery helps the sector, and I think the biggest appreciations in value will be auto, industrials, and at a later date in the cycle, real estate.
What would you do with another holy cow like HDFC, which is there in pretty much every global portfolio? Do you see valuations contracting there as well?
We've been sellers in HDFC for the best part of the last year, and as given the tight money market conditions, obviously there will be some impact on their funding cost. But our greater focus really with HDFC has been the fact that regulations vis-a-vis non-bank home finance companies, regulations have changed quite fundamentally in the last couple of years, and in particular it's become easier for home buyers to refinance away. So if you had borrowed from HDFC or indeed from LIC Housing Finance or any of the NBFCs, you can now refinance away to an SBI or an Axis Bank who are offering more attractive rates. This was not possible to do 2 to 3 years ago. I remember because I was personally a borrower from one of these NBFCs 2 to 3 years ago. You couldn't refinance, now you can, and I think consumers are availing of that, and that is putting pressure on HDFC's net interest margins and the whole construct of being a non-bank which competes with banks in a heavily competitive space like home finance. I think that is a pretty difficult construct to sustain, I would say.
What about autos, since you like that space? I mean, if you had to buy just 2 auto companies or 2 auto stocks for a 3-year outlook, what would those 2 be?
The easy ones to go for really would be Maruti. I think Maruti at 1,300 odd rupees, given the strength of the company's export franchise, its undoubted ability to build a much bigger export franchise than what it has today, given its strength in the domestic market and especially in the small car market, Maruti at 1,300 rupees I think is very, very attractive. Bajaj Auto is the other name I would go for. I think again it's a play on elections, on monsoons, and on the export market. Probably of all our auto companies, this is the one with the strongest export franchise, and our channel checks in Africa and Middle East suggest that Bajaj is now significantly cheaper than Chinese bikes which are being exported from China into Africa. You've got a superior bike available in export markets at attractive prices. I think those are straightforward bets to go after. For those with a greater appetite for risk, I would point them towards Excite, which I think has made the beginnings of what I think will be a strong revival in their pricing power. I think you'll see Excite pushing up prices pretty continuously over the next 3-4 quarters. And if, as I expect, FDI insurance gets approved by Parliament, then the whole concern about Excite's free cash flows being used to finance their insurance venture will also dissipate. The other anti-consensus bet I would point clients towards is TVS Motor. This is the cheapest of the bike companies for a good reason. They've underperformed operationally for a number of years now. But at 6 times earnings with a tie-up with BMW in the bag, and I think it's a pretty substantive tie-up with BMW in the bag, I think the market has oversold TVS. So for greater upside, Excite and TVS, and for a safe ride, Maruti Suzuki and Bajaj Auto.
Thanks very much for joining in today, Saurabh, with your views. Appreciate it.